Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for another CSE podcast. I'm joined today with Brent Wolfe with MNP. Brent is a partner and National Director for Public Companies. Thank you for joining me, Brent.
Happy to be here. Thanks, Anna.
Okay, so today we're going to dive into, I think, issuers' favorite time of the year, right? And that is every year our issuers, public companies in Canada, are required to do a audit and provide financial reporting and disclosure for the markets, correct?
That's right. So any public company with a December 31st year end, which would be most of them, has to file their annual audited financial statements if they're venture listed, like all of your CSE or most of your CSE issuers would be, by April 30th of 2026.
All right, so we're gonna dive into all exciting things about the annual audit, but first, tell us a little bit about MNP and its role in the Canadian capital market space.
Sure. So MNP is one of Canada's largest accounting firms. We do accounting, tax, and advisory, and specifically within the capital markets, we're heavily focused on assurance, so helping you get those audited financial statements done. We represent about 450 reporting issuers in Canada across all of the exchanges, and about 90% of those would be on a venture listed or venture exchange. So very heavily focused on the mid-market, both from your smallest shells and junior exploration companies to the highest operating companies you'd see on the upper end of the venture space.
Amazing. Very cool. And I know that you're very active with CSE listed issuers. You've been very supportive and a big advocate for a lot of the emerging sectors that have come to our market. So we're very appreciative of that. The next thing I just want to break down a little bit for our audience is maybe you could tell us a little bit about the regulatory and audit landscape for public companies.
Yeah, so this has become a bit of a challenge for, I think, a lot of issuers in recent years. Being able to find an auditor has started to become a bit of a challenge. A lot of factors are driving that. One of the main ones really is cost. And so we looked at some of the numbers. So for venture-listed issuers in Canada, from 2022 to 2024, had a 42% of them had an increase in their audit fee of 25% or more. Now, we've had some inflationary environments.
Jump.
It's a very big jump.
Yeah.
So, inflation has been present in the last couple of years, but nowhere near those numbers.
Okay.
And so we've spent a lot of time thinking about and looking at where some of those increases come from. And I'll tell you, it's not going straight to the bottom line for the audit firms. It's really driven by a lot of the increased effort required by the audit firms to meet sort of meet the audit standards and meet the regulatory bar, which can continue to be a challenge. And it's also resulted in a decrease in supply of auditors, as some audit firms have actually pulled back on either the number of reporting issuers that they do or whether they work with issuers that are listed in Canada at all.
I mean, let's be frank, at the end of the day, what we're seeing is an ever-increasing regulatory framework that's being created from all levels, whether it's from the regulators on the security side or on the auditing side. And really, I think this is all an effort of providing further shareholder protection, right? That's our goal at the end of the day.
Absolutely, and I think that's what we all want to do. Certainly as auditors, our purpose is to protect the shareholder to some degree, and the audit regulators would have the same mindset. The audit regulators effectively audit the audit firms,
right.
for lack of a better word and or better term for it, and their sole purpose is to protect the user and protect the investor. And so we do all have an aligned common ultimate goal, but
it just costs more money.
Well, one of the things that we see in the venture space specifically is that a lot of the ways that is carried out is not quite fit for purpose for the venture issuer. So what I mean by that is, you can't...
Sorry, I'm just going to stop you there for a second. Let's just maybe define for our audience, because you keep mentioning venture issuer. Can you just touch on venture versus non-venture issuer from a financial reporting perspective?
Sure. So from a financial reporting perspective, a venture issuer would be a CSE listed issuer not on the senior tier, or a TSX venture listed issuer, and their reporting requirements are they've got a little bit more time to get their financials
because they're typically
filed.
smaller.
Exactly. They've
smaller
got less
operations.
resources in the finance teams and so forth. So they would have 120 days after their year end to post their audited financial statements.
Yep.
And they would have 60 days to post their interim financial statements. Whereas a non-venture issuer, so somebody that would be listed on the TSX Big Board, would have 90 days to issue their audited financial statements for the annuals,
Right.
and they would have 45 days to issue their quarterly interims.
Now, if I remember from my days of working with public companies, when you finally get through that annual audit, that Q1 reporting period comes really fast.
That's right. Yes. So it's, I mean, on your typical December year end, you've got April 30th filing deadline for your annuals,
Yep.
and then you've got a May 31st or May 30th filing deadline
Yeah.
for your interim. So you've really only got 30 days to turn that around. And not everybody gets their interim financial statements reviewed by their auditor. It's not a
Right.
requirement. But if you are looking at doing a financing, filing a prospectus, then you do have to have your most recent interims reviewed.
Yeah.
So a lot of our issuers, particularly in a market where there's a lot of activity and interest from shareholders or investors, they will want to have their interim statements reviewed every quarter.
Right. Okay. Okay. So let's get back to what you were diving into. So we were talking about venture issuer requirements and their financial reporting needs.
I mean, the venture issuer requirements, like I said, are 120 days
Right.
post year end to file their annual financial statements. But what we're finding is that although they have a lot of time, there can be a lot of delays in the process. I mean, when you're a venture issuer, your goal is growth, right? And you're out there looking for capital. You're trying to build your story. You're trying to sell your story.
Yep.
And through that process, you'll often enter into business combination agreements, or if you're an exploration company, you might have a new option on a property or something like that you enter into during the year, or maybe even something like a royalty arrangement or a streaming arrangement, which can be complex from an accounting perspective. Mm-hmm. And so what we find oftentimes with venture issuers is that while they're very effective at moving their business forward and looking for sources of capital, and often doing so in very creative ways, they don't think about what the accounting implications could potentially be of those things. And I'm not sitting here saying that you should make business or operational decisions based on what the accounting will be. The accounting should never drive business. However, it is something that needs to be maybe not top of mind, but maybe second thing in line, so that once you enter into one of these arrangements, whatever it might be, you do need to work with your finance team, and your finance team needs to work with your auditors to determine what the accounting should be, because we oftentimes see that these issues aren't addressed until the audit comes around, and then there could be major complexities buried in some of these agreements that only surface, in April,
Right.
that all of a sudden you have to deal with between your finance team and your auditor.
Yeah. Okay. Now, the reason that we're having this conversation at the end of 2025, beginning of 2026, is, as you mentioned, most public companies typically will have a corporate year end of December 31st, right? Okay, so I've heard that one way of making your life a bit easier in engaging with auditors is having a different year end. Is that true?
It could be helpful for sure. I mean,
Just because your workload is maybe a bit less?
Our busy season is generally sort of February to April, so it's really that crunch time, because the vast majority of issuers would have that December 31st year end.
Yeah.
And so when we talk to issuers that are having a tough time finding an auditor, almost all the time it's a December corporate year end company, because the audit firms are so busy that time of year. And I spoke a little bit earlier about the lack of supply and it being a bit of a function of busyness, but also some audit firms just pulling back from either how many issuers they work with or whether they're working with public issuers at all. And so when we've got this sort of shrinking supply and an increasing number of issuers with December year ends, it results in a major crunch when we look at that sort of December year end.
Yeah.
So certainly when I talk to prospective new issuers, I will encourage an off-calendar year end. It can often result in lower cost for your audit, and also just more general availability of your auditors. Now, I do so knowing, too, that there are oftentimes reasons, and good reasons, business reasons, that you may want a December 31st year end. So I would never suggest that that's, just to have a easier, cheaper audit or whatever is a reason to change a year end. But if you don't have a compelling reason to be December 31, then I would certainly encourage a prospective new issuer to have an off-calendar year end.
Okay. Now, to touch a little bit on the reason that auditing firms might be lessening their load of issuers that they take on or not taking on new clients, is because your audits are defined. Your audits from the regulators are defined by how many clients that you have. Is that right? or your additional resources needed? Is that?
Yeah, a little bit of both. There's a sort of a soft line where if you have over 100 reporting issuer clients as an audit firm, then you will be inspected by our regulators on an annual basis.
Right.
Whereas if you have under 100, then generally it's on a less frequent basis.
And the more you're audited, the more resources you need internally to handle your own audits, right?
That's right, and they've also sort of expanded their inspections to cover. When I say they, I mean our regulators have expanded their inspections to cover the control environment within the firms as well. And so there needs to be, or there has needed to be, a major build out of resources within the firms, both to address audit quality at the engagement level, so an issuer by issuer audit basis,
Yeah.
but also within the framework that the firm has in place as a whole.
Okay.
And so that's resulted in a major increase in resource need at audit firms. And of course, the cost of those resources is passed along to issuers in the form of audit
Right.
fees.
Right. Okay. So let's get into the fun stuff. Let's find ways that we can help issuers make their life easier, because it's not just saving money, it's also saving time. I think that there's, as you mentioned, there are some practices that could be implemented into various processes. Maybe it's an ongoing process that they're doing throughout the year that can save them a lot of time and money when it comes to that audit season. So what are some ways that issuers can start acting more efficiently and saving some money at audit time?
The biggest thing is to start early.
Okay.
So one thing I mentioned is if you have an off-calendar year end, you may be able to even get a bit of a discount on your audit.
Okay.
And so if you don't have an off-calendar year end, that doesn't mean that you can't have some of those savings.
Yeah.
So one thing that we encourage a lot of our clients to do is some level of what we call interim testing. So that would be going in and doing testing during the year or throughout the year.
Okay.
So we'll get our planning done, and even some of our other audit testing we'll do as much as we can before the end of the year.
Okay.
That's when we have more time and availability, and there's just less going on, both with us and with our issuers as well.
And you also mentioned engaging with you as transactions are happening, so that if they're doing some financial reporting, it's not getting fixed at the end of the year. Is that a key one as well?
That's probably the biggest one.
Okay.
Yeah, so again, whether it be an acquisition, a financing arrangement, anything that's outside of your normal course of day-to-day operations that could have a complex accounting impact, I would encourage every issuer out there to get in touch with your audit firm. One thing that I'm really proud of that our firm excels in is in working with our issuers throughout the year in that capacity, but we can only do so to the extent that we get looped in on what's going on.
That's right.
So when my clients call me in June and say, hey, we're looking at this acquisition, that's the best possible
Okay.
scenario, where I can look at draft agreements and help advise them a little bit on what the accounting could look like depending on how they
Okay.
structure a certain arrangement. Doesn't need to be that way, but that's certainly my preference as the auditor. Second would be looping us in, immediately afterwards, and then working out what the accounting will be before the year end.
Yeah.
It also helps if we don't come in until year end, and you've already reported on some quarters. You may have to adjust some of the numbers at year end, and then all of a sudden you have to ask yourselves as an issuer, was there a material misstatement in some of the interim financial
ouch.
statements
Yeah,
that we filed?
that would hurt.
Exactly.
Yeah.
And so while we don't provide assurance on those, and we can actually tell the issuer if they need to refile or not,
Right.
if they undergo a continuous disclosure review, that could very much come up, and they may be required to refile
Yeah.
one of their interim statements afterwards.
I mean, look, when our issuers are in a state where they are, working on a transaction, they are overwhelmed with trying to raise capital for the transaction. They're dealing with their legal counsel to help them with that transaction. But if you can find that extra time, you're saying engage with your auditor as well. It might save you a lot of time and hassle going forward.
Absolutely.
Okay, good to know. What about, again, I'm thinking of the days where I used to work with public companies, and especially in the exploration sector and in unique jurisdictions. I mean, we were still dealing with, receipts that were getting faxed to us, and I might be stating my age here, but with updated technology, is there ways that issuers can be helping themselves, and is AI a part of this? Is there some technology that can help issuers?
There is, yeah. We're certainly starting to use AI in some of the audit procedures that we do to help streamline some of the work that we do. Some of the more mundane tasks as it relates to an audit would be things like looking through invoices that used to be, you used to get like a box of invoices and go
Yes.
through them all.
Yes.
And so now
And they were crumpled, right?
always,
And
yes.
sometimes faded in certain places that were really important.
Yeah. And so a lot of our issuer clients now will have, like a QuickBooks Online, for example, where all of their invoices will be scanned in PDF format in their accounting system. And so a lot of times they'll actually give us sort of read-only access to their accounting system,
Okay.
where we can go in, make our own sample selections and pull those
Okay.
invoices out. So it actually alleviates a lot of the burden from the issuer themselves. And then this is just one example, but one thing we use is an OCR tool that helps read those invoices and actually pull out the necessary information from the invoices on its own,
Amazing.
rather than what I had to do back in the day, which was sort of leaf through all of those faded documents and try to make heads or tails of them.
We're making ourselves look old here, Brent. What kind of internal practices should be happening, whether there's a transaction or not, or depending on when their year end is? What kind of internal practices help issuers through that audit process? Because maybe actually before we get into that, maybe just touch a little bit on what is the standard? It's a test, right? So you go in, you do sample tests of various transactions that occur throughout the year and ensure their accuracy. Is that essentially what an audit is?
Pretty much, yeah.
Okay.
There'd be certain assertions that we look at for each kind of risk in a financial statement,
Yeah.
and ultimately we try to achieve reasonable assurance is the term that we use over the financial
Yeah.
statements as a whole within a material number. So every audit will have its own materiality, and we try to obtain reasonable assurance that the financial statements are not materially misstated.
Yeah.
And so that's done through a variety of tests, and there will be different risks with each. So
Okay.
the things like the looking at invoices are sort of present in all audits.
Yeah.
But really the areas where we oftentimes run into challenges with timing or cost overruns or things like that are on some of those unique or complex transactions that I've kind of spoken about,
Okay.
the complex financings, the acquisitions, those things where, a small nuance in an agreement could actually flip an equity instrument into a debt instrument.
Right.
And then require revaluation periodically and have some more complexities.
Right, right. So it has impact. So going back to the question, what are some internal practices that really help issuers be always prepared for their audit?
Yeah, so that early engagement of your auditors is a real
Okay.
key one. The other one I would say that comes up quite often, and it may sound counterintuitive because it's an upfront cost, but it's assessing the sophistication and capability of your finance team. A lot of venture issuers will not have a full-time CFO or finance
Right.
team, and then they go and enter into these complex arrangements, but the finance team that they have in place may not have the capacity or skill set to deal
Okay.
with some of the accounting behind some of these things. And so oftentimes we'll encourage because we're limited in how much we can assist as auditors. We need to be independent of the company.
Right.
So we will encourage our issuer clients to go and find some external sort of consultant type help to help deal with what an accounting position paper and then ultimately financial statement should look like
Yep.
for a specific sort of complex issue. And so while that does give rise to an upfront cost, you have to go hire somebody else to help you. 9 times out of 10, it results in a lower ending cost in total of what your audit would look like if you tried to sort of, work through it on your own as a team and have a bunch of back and forth with the auditors.
Okay.
The same goes for financial statements. I've had clients where there's been 20 or 30 turns of a financial statement, meaning I review it that many times.
Wow.
And it takes hours and hours. The first time certainly takes like a number of hours, and then
That's
even
a lot of times to read
It's-
one
it's a lot.
financial statement.
and so as you can imagine, those hours add up, and
Yeah.
that cost ultimately
Yeah.
is passed on to the client, and it winds up being very, very expensive. And I've got other
Right.
clients where it's like 2 turns and we're done.
Yes.
And that level of efficiency results in major cost savings
Okay.
to our clients.
Okay. So maybe invest in your finance team internally. Spend a little extra on that finance team. Make sure that they have the capable knowledge for what you are doing specifically, as your operations of a company, right?
Either invest in a finance team that can do it full time, or just know when you need, or based on your auditor's advice, go out and get external help on an ad hoc basis. I would say that's a little bit
Okay.
more common than, I'm not going to sit here and tell an exploration company that they need a full-time CFO.
Right, of course.
But, should they enter into one of these transactions, then they very likely
specialized
will need
assistant.
some help. And we would work with a number of firms that we're friendly with that would help with that kind of stuff.
Okay.
And so we're oftentimes, placing our clients with a consultant that we know knows a particular type of transaction well that can help them.
Okay. From your, look, you see deep inside many issuers in the Canadian marketplace. Are there any trends that you're seeing or that you've seen in 2025 that you find interesting? Any sectors that you see more than another?
Well, of course, we're seeing the mining sector, a resurgence in the mining sector, which is fantastic. I think
Very exciting for me. I love it.
People have been waiting a very long time, and there's been, I think, a lot of excitement and optimism for the last couple of years, probably. But now, I think we're actually seeing that optimism translate into deals getting done. Started in the spring and has even continued a little bit through the summer, and now that we're into the fall and winter, we're seeing the deal flow increase like crazy. So a lot of it is in the mining space. We're also seeing a lot in the tech space as well. I'm working on a go public AI deal right now, for instance, and so
we've seen that at the CSE as well, which is exciting. It feels like, and it just feels like the AI solutions that are coming to market, their applications have real value in them. Unlike some of the other emerging sectors we saw in the tech space, I feel like these are here, they have a lot more staying power than maybe some of the other movements we saw.
We certainly hope so.
Yeah. Okay, I'm putting you on the spot here a little bit with this question, but I'm just curious, since you understand our financial reporting needs so well as a public company, as an investor, what part of the financial reports do you think are important for investors to look at when they're doing due diligence on a company? Where should they look?
Capitalization, I think, is the main thing that I would look at. We will, and you need to look past just the face of the financial statements, I think, to really understand that.
Okay.
I always prefer seeing, as a prospective investor, I always prefer to see more debt, more equity capital than debt. But of course, it's also a challenge to keep your cap table relatively tight, not have too many shares out. So I understand there's some give and take there, but the one thing that is challenging if you're investing, and I guess I'm speaking a little bit less about the exploration and more about sort of an operating or aspiring operating company right now. But if you're ultimately planning on generating cash inflows through revenues, if you've got a boatload of debt that you've built up over the years that you need to service with every dollar that you bring in from revenue, when are you ever really going to be able to increase your share price and realize and achieve profitability?
Okay.
So I think looking for debt is important. The reason I say you have to look past just the balance sheet is because I spoke a little bit earlier about debt versus equity. And that oftentimes comes into play on convertible debentures, which is a very common financing vehicle that's used. And so depending on terms of a convertible debenture, you might have what would otherwise be classified as equity looking like debt, and it could look like really big debt. So the valuation models that are used to value convertible debentures, and particularly like the conversion features and some of the nuances to those, the valuation methodologies are built for the Fortune 500 companies in the world. They're not really built for a venture issuer. And so oftentimes you can get pretty wonky valuations that come out of some of the inputs that you put, even though it's the same model, just because of some, share prices are smaller. And so a 10% change in share price of Apple does not really mean the same as a 10% share price change of a 10-cent issuer.
That's right.
But it will have a very significant impact. And so, I would have clients that would have debt of $50 million related to a convertible debenture. But are they ever going to pay back $50 million in cash? Absolutely not. That's why I say it's important to look to the notes of a financial statement and really understand what the terms of conversion are. So if a deal is if a convertible debenture is in the money for a particular period of time and you're in the money by 5 cents, but that 5 cents is actually 50% of the stock, well, that's going to have a massive value on the from an evaluations and financial statement standpoint, but it may not be that significant to you as an investor making an investment decision.
Very cool. Thank you very much. Okay, Brent, let's get into some hot topics that we're seeing come to market this year and next year will be affected by. Let's start off with IFRS 18. What is that?
So IFRS 18 is a new accounting standard that's coming in, which will impact the presentation and the look and feel of the income statement on the financial statements,
Yep.
as well as what they're calling management-defined performance measures, or MPMs, and things that were previously were referred to as non-GAAP or non-GAAP measures in the MD&As. A lot of those are now going to be coming into the financial statements and therefore subject to audit under this new standard.
Okay, so for those that don't know, IFRS is the International Financial
Reporting
Standards. Thank you.
Yes.
And GAAP is used in the U.S. and that stands for Generally Accepted Accounting Principles.
Yes.
Do I
very
get a gold
good.
star?
You do.
Thank you.
Yes.
So we used to be GAAP and we transitioned to IFRS years ago, right?
Yes, but there was a national instrument published a couple of years ago that they used the term non-GAAP measures, I believe, or non.
Okay.
I'm using the term non-GAAP or non-IFRS measures,
Okay.
Sort of interchangeably here.
Okay.
But it set out requirements around disclosures in your MD&A for any what non-GAAP or non-IFRS measures are, meaning
Okay.
sort of things like adjusted EBITDA and stuff like that.
Okay.
So that's not actually a measure currently that's defined in our reporting standards,
Okay.
but it's a number that you'll see oftentimes in the MD&As that's disclosed.
Okay.
And so the Securities Commissions put out a new national instrument which required a reconciliation from any of those back to what the IFRS measure in the financial statements would be a couple of years ago,
Okay.
to allow for better comparability, and because they found that people were kind of making up their own ways of getting to adjusted because adjusted EBITDA, what does that mean?
Yeah.
Right? You could just sort of put anything in there.
Yeah.
They began to require reconciliations back to
Okay.
like an audited
So
number.
creating some consistency, is that right?
Yeah, it allows for more consistency
Yeah.
for sure. And so that was something put out a couple of years ago for your MD&As. So a lot of those measures are now coming into the financial statements under this new IFRS 18 standard,
Okay.
And therefore will be subject to audit.
Okay, so how does this affect issuers and how do they prepare for this change?
Yeah, so this is not effective until January 1 of 2027. So
Okay.
and any
Okay.
of your fiscal 27 financial statements that'll need to be included. However, you'll also need to present your comparatives as you do with any statement that you put in now.
Okay.
So really anything starting Jan 1, 2026, if there's impact there, you'll need to be able to track those
Okay.
and reflect them in your 2027 financial statements when you submit them.
And your auditor will probably be helping you through this process, right? As they do your audits for 2026, they'll be getting you ready for that?
Definitely,
Okay.
yeah. Well, we certainly are, and really the biggest impacts are on, like I said, so there's the management-defined performance measures that we talked about.
Yeah.
That's a bit less of an urgent issue, I would say, today. The bigger one is going to be the presentation of the financial statement.
Okay.
So if you think about the way a cash flow statement looks today, it has operating, investing, and financing activities.
Yes.
So the income statement is going to be split out into three categories similar to that. They're not quite the same, but they are operating, investing, and financing.
Okay.
And so depending on the nature of an expense or cash inflow or revenue type item, it will go into one of those three sort of categories in the future.
Yep.
Now, some issuers may not need to change anything, and it may be very intuitive where their accounts need to go. But there's others that may have transactions going into accounts that will, in the future, need to be split out into an operating version of that account, an investing version, and a financing version.
Okay.
Now, this may not impact a ton of issuers. You may think it may not impact a ton of issuers, but one area where it will have impact is in foreign exchange.
Okay.
A lot of issuers or a lot of companies in their chart of accounts, in their general
Yep.
ledger, will have one foreign exchange account.
Right.
And everything goes there, and you see it in one line on the financial
Right.
statements today.
Because they're operating in that country or they are.
Yeah, they'll have
Yep.
transactions
Yeah.
in a foreign currency.
Gotcha.
And so under the new presentation standard, there will be foreign exchange for operating activities, foreign exchange for investing, and foreign exchange for financing. And so to be able to track those, of course, you need to have separate accounts to be able to do that. And so that's a small example. It sounds maybe like
Yep.
it won't be a big deal, but a lot of issuers, even if they don't have complex businesses, may have transactions in a foreign
Right.
currency. And so something like that and adding those accounts on January 1st of 26 will set you up better for the future so that you don't have to go back and think, oh, like I need to remap all of these
Reconcile.
transactions
Okay.
that took place.
So in 2026, ask your auditor if they are preparing for IFRS 18.
That's right.
Okay.
And also, I'll maybe do a quick plug right now. We've got something that we run every year called the Exchange Series at MNP, and
Yes.
it's an event, and we do a flagship sort of accounting and assurance update every January, February timeframe. And so that's happening in Vancouver, February 3rd, and then January 30th in Toronto, and we're also doing a Calgary session as well. So if you're in any of those locations, reach out to your local partner. But we're going to be touching on IFRS 18 as a significant topic.
Great.
As well as a couple other things coming down the
I
pipe.
feel like I've been to that before, and it is a really great series. So I highly suggest that you check it out. Whether you're a CFO or not, I found it very valuable. Okay, let's talk about one other hot topic. This is an interesting one. CSA has made a proposal for semi-annual reporting. Now, in parts of the world, this is already implemented for public companies. Tell us all about this.
Well, I mean, there's not, I guess, a heck of a lot to tell. It's a proposal that's put forth right now for comment. The comment period closes December 22nd. So if anybody out there is feeling passionate about that, and encourage you to put a comment in. It's pretty self-explanatory in that instead of having to file your interim statements on a quarterly basis, the proposal puts forth an option for certain venture issuers to file on a semi-annual or every 6-month basis. Not every venture issuer will qualify for the pilot program that they're doing, but a lot will. And of course, the idea here is that it would increase or allow for more time, decrease costs for the issuer as it relates to compliance. The flip side of the challenge that a lot of folks are raising is the decrease in visibility in terms of what's going on with an issuer. Now, I'm of the view that for the most part in the venture space, investors transact on news releases more so than they do historical financial statements. But that said, financial statements are still important because they're the only document that gives you a snapshot at a periodic point in time of everything going on within a business.
And I think just to display a little bit what you're referring to is, for example, an exploration company, if they are heavy in operation mode and they are exploring, you can see every 3 months how much money they're spending on that project. So it gives you that very quick, at least you can see what's happening there. The flip side of that is that for a small exploration company, they're having to put resources and time aside from what they're supposed to be doing, which is exploring, to be getting those quarterly statements done. So there's a bit of a give and a take to this, right?
That's exactly right. And so that's, I think, the ongoing debate right now
Right.
Around whether this is ultimately better for the investor or not. And it's investor dollars, not only time, but investor dollars that are going today to putting your quarterly statements together rather than potentially into the ground in that exploration example.
Right. Now, I did hear somewhere that they are looking at solutions for maybe having a simplified quarterly reporting, whether it be a cash flow statement or something along those lines that at least gives you a very simplified snapshot. So I think they're trying to figure out the best solution, but it definitely would ease venture style issuers, right?
That's right. Yeah, and there may be some kind of middle ground that we can achieve that will not necessarily withhold some important results to investors, but will not add as significant a cost and time burden today as doing a full set of sort of interim quarterly review statements.
Anything that you want to pass along as advice to issuers that are out there either looking for an auditor or needing to change an auditor? Is there any guidance you want to give issuers as they start that process?
I would say engage very early on.
Okay.
The later you go in the year, the more challenging it becomes for us to take on new work, or for any auditor to take on new work for that matter. We really need some time to get to know you, get to know your business, and sort of get our arms wrapped around the risk.
So calling you mid-December might not be a very successful
It's very challenging to get a call mid-December. It's, at the end of the day, we're in business like everybody else, and we hate to turn away work, but oftentimes when the phone rings mid-December for a December year-end, that's a tough one for us.
That's right. Okay, good to know. Well, listen, Brent, thank you so much for joining me today. If issuers want to get more information at MMP, where should they go?
Well, you can find me on LinkedIn, and my information is available on our website as well. Give me a call. Happy to chat, or if you have any connections with MNP, any of our folks, give them a call, and it'll find its way to the right people. If they're not someone that works in our capital markets group, then they will find someone who is.
That's great. Thank you so much for joining me.
Thanks for having me.